Welcome to the AIB-AXYS Africa Investment Play 2024 webinar. Thank you for your time. In this webinar, we'll provide an in-depth analysis of the current macroeconomic landscape. This is both the local and global landscape. And after this analysis, our team of experts, who I'll introduce very soon, will share the investment opportunities they have identified for 2024. So you're in the right webinar. This is a great opportunity for every one of you to learn what are the pockets of opportunity available for you. I'll be your moderator for this webinar. And before we kick off, allow me to give a brief overview of AIB-AXYS Africa and then the speakers for the day. With a track record of 25 years, AIB-AXYS Africa has served as an investment partner. We specialize in stocks on the Nairobi Securities Exchange, investments in treasury bonds and bills, derivatives, and more recently, offshore investment opportunities. And we are committed to enabling investor success. Investing with us means that we will provide you not only with strategic guidance, but also all the practical help you need to succeed in your investment journey. I'll also be sharing our contact information in the chat. So if this is the first time you're hearing about us, we'd love to get in contact with you. And now to our speakers for the day. We have Ronnie Choka. Please allow me to read his profile. Ronnie Choka is the Senior Research Analyst at AIB-AXYS Africa. His areas of expertise range from macroeconomics, equities, and fixed income analysis across developed, emerging, and frontier markets. He graduated with a first-class honors in economics and finance from Kenyatta University, and he's also a finalist of the ISIFA program by CASNEV. He is also an economic correspondent for local and international media houses such as KTN, Citizen, K24, and CNBC. And our second speaker for the day is Stacey Macau. Stacey is a research analyst with AIB-AXYS Africa. She graduated also with a first-class bachelor's degree in finance and economics from USIU. And Stacey brings a wealth of knowledge specializing in equities, fixed income analysis, and macroeconomics. Her insights on the capital markets and economic landscapes have been prominently featured in newspapers like Business Daily. We also have Anthony Kiambati as a panelist who will be joining in during the Q&A session for any queries on derivatives. Welcome, Stacey, Ronnie, and Anthony. Before we start, if you have any questions, please feel free to write all your questions in the Q&A section. And at the end of the presentation, we'll address them during the Q&A session. We'll have about a 15 to 20-minute Q&A session at the end. All right. And with that, I want to welcome all of you again, and over to you, Ronnie and Stacey.
Thank you very much, Naila, for that warm welcome. And to all our distinguished guests, good evening and welcome to the AIB-AXYS Africa Investment Play 2024 webinar. The much anticipated webinar where we prepared a lot of groundbreaking insights on the macroeconomic, equities, and fixed income sphere. Allow me to present my screen. So this is a presentation of the Investment Play 2024, which we released earlier this month. And herein we have a breakdown of the equities, fixed income, as well as the macroeconomic sphere. Our theme for this year is swinging into action. And hopefully, as we delve into the presentation, we'll engage with you and indeed convince you why a proposal as to why you should swing into action despite the market volatility, as it were. So in my presentation, I'm going to begin by looking at the global macroeconomic outlook, and then also open the floor for Stacey to take us through the Kenya macroeconomic outlook before coming back to take us through the equities and fixed income outlook, and topping it all off with portfolio management investment implications for 2024. So sit in and beg your indulgence as we delve into this presentation. So starting off with the global macroeconomic outlook, how was the year 2023 in summary? Firstly, 2023 was a year where we witnessed multiple overlapping shocks. Just as the global economy was recovering from the embers of the health pandemic, then we had the onset of the wars in Eastern Europe and Middle East, which disrupted fragile supply chains, triggering cost of living pressures. And in response, central banks opted to raise interest rates in order to quell the inflationary pressures. However, this elevated rate environment has piled immense pressure on corporates, households, even sovereign governments and markets overall. The second force we think shaped 2023 has to be the shifting global growth patterns, where we saw the global economy record a general slowdown in 2023. However, this growth became more divergent in the year and across global regions, even surprising on the upside in several cases. We saw a significant rotation of demand from goods to services, led by tourism, which propelled economic growth in service-oriented economies. The third force we think shaped 2023 was the focus and the increased conversation around public debt sustainability. Unlike yesteryears where governments were largely pro-expansionary, meaning they could spend to cushion the vulnerable low-income groups in the form of subsidies and transfer payments. And this accelerated, especially during the pandemic period. Yet this also came with a worsening of public debt sustainability indicators in 2023. As such, countries are still struggling with limited fiscal space for development spending and social welfare transfer payments, pointing to the eroded fiscal buffers in 2023. So right now we're hearing the conversation, especially in emerging and frontier markets, revolve around fiscal consolidation. And this is just a polite term for cutting government spending and also while also mobilizing revenue growth. So what does the year ahead hold for us? Or what are the key themes we think will shape 2024? Firstly, the first theme we identified is that politics are likely to keep markets guessing. So firstly, the ongoing Gaza and Ukraine conflicts still threaten to split major world powers into rival blocs. And of course, the risk from this is that we risk disrupting the recovering supply chains and in the process, we slow down global trade. And also, we know that countries representing 60% of global GDP are set to conduct elections in 2024. Such nations such as the US, United Kingdom, Russia, and also emerging markets like South Africa, India, Mexico, and so on, conducting elections. And the risk we see from this is that we're likely to see policy inflection points in 2024. We think nations are likely to become more protective of their economies as the growing uncertainty in the global economy piles pressure on these economies. The second theme we think will shape 2024 is the growing burden of higher for longer interest rates. So, as we pointed out earlier, the rising interest rate environment has wrought significant financial distress, not only for corporates, but also for sovereign governments across developed and emerging markets. And some of the lingering effects of this are evidenced in the widespread slowdown in credit demand, and also in the form of rising stock of non-performing loans for the banking sector as a whole. And in the process, we've witnessed a slowing economic momentum. We're also hearing from key central banks at the moment that we're likely to pivot toward rate cuts in the year. However, as we reiterated in our outlook, we don't expect a sharp U-turn in the path of interest rates. We think any rate cuts, if any, are likely to be gradual and intermittent at best. And as such, we think this will keep the narrative of higher for longer remaining at play in 2024. The third thing we think will shape the year has to be the widening divergence, both across and within asset classes. So in 2023, we witnessed increased dispersion in returns, both across and within sectors. And this points to the impact of higher volatility materializing in the markets. In the equities front, we saw, because of the shifts in the business cycle, we saw some sectors outperform relative to other sectors, such as, for example, oil and gas, banking sector recorded tremendously better performance compared to manufacturing sector, as you shall see in coming slides. And on the fixed income side, we saw also a widening of credit spreads between developed market bonds and developing market bonds, largely on the back of the growing debt sustainability risks that we pointed out. In terms of growth prospects for 2024, we expect mixed fortunes across global regions, and this comes predominantly from the shifts in global demand. As we pointed out earlier, we are now witnessing a shift from the demand for goods to the demand for services, led by tourism and financial services, while the elevated commodity prices continue to weaken overall demand. If you look at the chart on your right, we expect growth in the Sub-Saharan Africa region to accelerate to 4% in 2024, up from 3.3% estimated by the IMF. While recession pressures are likely to be more pronounced in advanced economies and also some emerging nations such as China. However, risks to these projections are still pegged on the lagged effects of the higher for longer interest rates, and also the looming supply disruption risks, and also the fiscal consolidation measures that most governments are adopting at the moment. Funneling it down to Sub-Saharan Africa, I think we see also a number of forces at play in the region. The silver lining has to be moderating inflationary pressures, largely supported by rebounded food supplies in the year, following improved weather patterns. That has led to a deceleration of overall inflationary pressures, and also thanks in part to policy tightening by central banks across the region. We generally saw inflation ease faster in nations that tightened their policy rates earlier, such as Uganda. And the second force we think will shape the Sub-Saharan Africa region has to be the widening exchange rate pressures, the widespread exchange rate pressures in the region. We are well aware that most Sub-Saharan Africa national currencies recorded exchange rate losses relative to hard currencies like the US dollar and the British pound. And we attribute this to the knock-on effects of interest rate tightening, as well as the deteriorated macroeconomic indicators. The third key force that's shaping the region has to be the rising concerns around fiscal sustainability, as I pointed out earlier, largely because the rising interest rate environment has coincided with a slowing tax revenue growth, which has led to an overall increase in the proportion of debt service to overall tax revenues for SSA governments. And this presents unique challenges in terms of financing growth and also protecting the vulnerable groups. The other aspect also comes in the weakening external demand for Africa's exports, leading to a general slowdown in economic growth in the region. However, we also see another bright story for the Sub-Saharan Africa region in the form of the acceleration of the Africa Free Continental Trade Agreement, which has uniquely led to an increasing contribution of remittances to Kenya. So one key highlight from our report is that African nations collectively contributed the lion's share to the growth of diaspora remittances. While the traditional sources of diaspora remittances like the Americas, Europe, and Middle East, while they remain, of course, the larger contributors in absolute terms, when we look at the growth for 2023, the growth emerged largely from the Sub-Saharan Africa region, presenting new opportunities for intracontinental trade. I'll now hand over to Stacey to take us through the Kenya economic outlook. I'll then be back to take us through the equities and fixed income outlook. Stacey, the floor is yours.
Thank you, Ronnie. Good evening. My name is Stacey, and I will be taking you through the Kenyan macro outlook. Services are on the lead during driving Kenya economic growth in 2023. Kenya's GDP growth exceeded market expectations to record a growth rate of 5.9% in the third quarter of 2023, compared to a growth rate of 4.3% a year prior. If you have a look to the graph on your right, you'll be able to see that GDP growth quarter on quarter was on a steady increase, unlike in the previous years, signaling a sustained trend of economic development that we expect to carry over into 2024. Growth in the services sector remained resilient, supported by a rebound in tourism and financial services sector, while the industry sector remains firmly on its recovery path. Similarly, growth in 2023 was driven by the rebound of the agricultural sector, resulting from increased food production from the favorable weather conditions experienced during the year. Subsectors such as accommodation and manufacturing contributed to the economic growth. We anticipate the economy to sustain its resilient growth at 6.1% in 2024 on the back of booming services sector and a recovery in real incomes. Risks to this projection are pegged on factors such as elevated interest rates, exchange rate pressures, and volatile commodity prices amid the global rising uncertainties that were mentioned earlier by Ronnie. Moderating price pressures, and I'll be talking about the price levels. Price pressures eased progressively throughout 2023 as signaled by the softening of headline inflation, which is a measure of overall inflation in the economy, to 6.6% by December of 2023 compared to 9.1% a year prior. This decline in the headline inflation was largely driven by lower food prices, resulting from increased food supply during the year. Core inflation, similarly, which is non-food, non-fuel inflation, declined during the year, suggesting that the general increase in prices slowed down, which essentially indicates a moderation in the underlying pressures on overall prices. While headline inflation remains within the National Treasury's upper target range of 7.50%, monetary policymakers are keen on lowering it to the midpoint target of 5% over the near term. We anticipate mild and transitory inflation rates over the first half of 2024, underpinned by stabilizing food supply growth and compressed credit demand in the real economy. However, we remain concerned with the economy's vulnerability to the global uncertainties, which we opine that it can trigger secondary inflationary cycles in the local economy. We expect inflation will remain susceptible to commodity price volatility in the international markets alongside exchange rate pressures. The cost of wait and see. So in 2023, the shilling lost significant value against currencies such as the dollar and the British pound. And this chart that we have here on our left shows the depreciation of the shilling in comparison to the Ugandan and Tanzanian shillings pegged on the US dollar. So on the global front, rapid monetary policy tightening in developed countries loosened interest rate differentials between the two regions. And as a consequence, there was a rapid increase in capital outflows because investors were seeking safety in dollar-denominated assets. Lagged policy responses alongside other factors piled heavy pressure on the Kenyan shilling. The expanding current account deficit, combined with the decline in our foreign exchange reserves, the heightened uncertainty also increased the desire for dollar-denominated assets. We attribute the relative performance of the Tanzanian shilling and Ugandan shilling to the resilient debt sustainability indicators, supported further by agile growth in foreign direct investments, which are FDIs, and exports. We pencil a marginal easing in the local currency's volatility, driven by a recovery of a raw export sector, alongside anticipated FDI inflows induced by the expectations of interest rate easing. Yes, so the shrinking buffers, which was the foreign reserves. Kenya's stock of official reserves stood at $6,612 million, enough to cover 3.5 months of import cover as of December 2023, which is below the threshold of 4 months. If you have a look to the chart on your right, you'll be able to see the gradual decline in official foreign reserves throughout 2023. The increase that you see around June, July was as a result of the IMF disbursement of $966.80 million. We anticipate foreign direct investment inflows from portfolio investments, tourist arrivals, privatization of state assets, coupled with capital calls from multilateral guarantors such as IMF and World Bank, to lift capital buffers closer to the required thresholds. This year, Kenya has already obtained disbursements totaling to $684.70 million from the IMF, which has contributed to the increase in our official reserves. However, we expect the repayment of external debt obligations, including the $2.07 billion Eurobond bullet repayment in June this year, to push the reserves to about 2.5 to 3 months of import cover. The lagging fiscal performance. The table above shows the fiscal performance for the first 5 months of the fiscal year of 2024. Revenue collection during these 5 months fell short with a performance of 82.2%. Despite this, the government revised its ordinary revenue targets upward by 22 basis points, which is 0.22%, to shillings 2,576.8 billion in its supplementary budget for the fiscal year 2024. This points to an ambitious exchequer eager to mobilize revenues and also to broaden the tax base. We expect that the implementation of the legislated taxes and levies outlined in the Finance Act of 2023, such as the increase in VAT on petroleum products, alongside with medium-term revenue strategies to progressively raise the revenue to GDP ratio to 20% target. We also noted with concern the minimal disbursement to development spending with a 29.2 absorption rate, which was lower than the county government disbursements of 67%. Yet, the government in its full year 2023-2024 supplementary budget estimates projects a 6.3 increase in total spending to 3,981.5 billion shillings to meet the arising needs ranging from food security, education, and disaster management following an El Nino crisis in 2023. And now we look at a lens on fiscal sustainability. The IMF projects Kenya's external debt service to exports ratio to peak at 31.1% in 2022, up from 22% in 2023. This increase is mainly attributable to the mounting external debt service obligations, which include the 2.07 Eurobond bullet repayment, which we expect to expedite the drawdown in official reserves. Despite these challenges, we believe that the government, the ongoing fiscal consolidation drive will contribute to lowering the debt vulnerabilities of the country. We witnessed yields on Kenya's Eurobonds cool in the latter half of 2023, following reassurances from multilateral finance partners in 2023, such as the IMF, on their ongoing commitments with the Kenyan government. We expect higher volatility in the near term, driven by mixed investor sentiment in an increasingly uncertain landscape, and the tying of loose ends through the monetary policy. The Central Bank of Kenya's Monetary Policy Committee implemented a cumulative 375 basis points, which is 3.75%, increase in the central bank rate to 12.5% by December 2023. This was in line with our 2022 predictions, where we expected the committee to increase the rate to anchor inflation expectations and also to mitigate exchange rate pressures in a bid also to address economic uncertainties. Private sector credit growth remained resilient despite the prolonged monetary policy tightening in 2023 on the back of fast recovering consumer demand. Looking ahead into 2024, we see more runway for further tightening of the policy rate to firmly anchor inflationary pressures and support stable inflows. We, however, estimate that credit demand will buckle under the pressure of elevated interest rates amid an extensive rollout of risk-based credit pricing models that are being implemented by the local lenders. This implementation means that both consumers and businesses will continue encountering heightened costs in their pursuit of credit. And now I will hand back to Ronnie to take you through the rest of our presentation.
Thank you, Stacey, for that comprehensive Kenyan roundup. I'd like us to shift gears now to the Equities Outlook. But before we look at the outlook, let's look at the year in review. How was 2023 for the equities market? We summarized 2023 as a bumpy road for equities, shaped by three major forces. Firstly being, we saw a widespread flight to quote-unquote safety assets, where because of the rising interest rates in developed markets, this raised the attractiveness of fixed income assets relative to listed equities. However, looking ahead, we think the expectations of looming interest rate cuts are likely to stimulate a reversal of investment flows back into equities. The other force we think shaped the 2023 equities market was the increased sectoral divergence. This is to say, we witnessed tremendous divergence or dispersion in performance of corporates, even for companies in the same sector, largely because of differences in the pricing power, market share, and also the reserves through which these companies had accumulated entering this phase of the business cycle. So all things clear at this level is that we are entering a new regime of higher volatility, unlike the yesteryears where the volatility was much lower and much more predictable. The third force that we think shaped the equities market was that small and medium cap counters continued to steal the spotlight from large cap or the popular blue chip equities as we know them. We saw small cap stocks continue to outperform large cap stocks because of an ongoing pricing in of fundamentals, whereas the large cap peers, the likes of Safaricom and KCB, their valuations broadly reflected the impact of market shocks. In terms of relative performance in the region, the African equities markets demonstrated resilient performance throughout 2023 to deliver an average return of 16.3% in local currency units. After excluding Zimbabwe, which was an outlier, posting a 981.5% return. However, when we convert the equities return into dollar equivalents, the scales shift. Now Egypt becomes the best performing market in USD terms, posting a 36.3% year return throughout 2023, whereas Kenya was the most discounted, posting a negative 43.2%, of course, being exacerbated by the weakening Kenya shilling. In terms of regional average performance, we saw Southern and Northern Africa regions generally post more resilient performance compared to Western and East Africa regions because of the variance in the economic shocks facing. Like, for instance, in West Africa, we had a lot of political instability in 2023, several coups at play in notable West African markets. Even in Kenya, we also had some bouts of political instability in early 2023. Political protests were at play, which really accelerated portfolio outflows by foreign investors, as it were. So let's funnel down to the Kenyan equities market. So how did the equities market perform broadly? So the Nairobi All Share Index trimmed 27.7% throughout 2023, relative to the median African average of 9.1% in local currency units. However, while this figure points to underperformance, we think in light of if you take the extra effort to zoom in, we think the index will hide a lot of divergence. Meaning, it's not, if you look at the Nairobi All Share Index, you risk losing a better or comprehensive picture of how some sectors were really outperforming in the year. For instance, agriculture sector posting an average valuation return of 22% throughout 2023, broadly reflecting the impact of improved weather patterns that really replenished volumes. And also for the exporting firms in this sector, the tailwinding of the exchange rate depreciation really supported revenue growth for these counters. For the automobile sector, we saw a discounting of up to 47%, of course, owing to the rising cost of inputs. For the banking sector, valuations broadly reflecting a compressed net interest margin outlook, as well as the impact of the rising non-performing loan ratio for the banking sector as a whole. For commercial and services, we saw a mild weakening of valuation of average valuations for the sector, largely driven by waning consumer demand and also the elevated inflationary pressures. Construction sector valuations largely improved 8% following a rebounded real estate activity in the year. We saw some merger and acquisition activity as well as some disposal activity in the year 2023, which really led to improved valuations for the sector. In the energy sector, we saw improved average valuations, largely propelled by rising energy prices globally, as well as the strong pricing power for this for companies in this sector, given the low elasticity of demand for energy products. For insurance sector, average valuations down 11%, broadly reflecting rising delinquencies for the sector, as well as rising claims ratio for companies in this sector. Investment companies also recorded a slump in earnings, broadly pummeled by rising interest rates and the impact of that on their financial securities, talking of mark-to-market losses. For manufacturing companies, average valuations up 4.3%, which was counterintuitive. And we think this now points to the resilience of the manufacturing sector. I think the balance sheet strength of this for the companies in this sector really helped them navigate the macroeconomic headwinds we saw. And in a way, it also reflects the optimism that investors have for the manufacturing sector heading into 2024. Telecommunication sector valuations, largely Safaricom, down 40%, 42.4%, broadly reflecting the impact of foreign portfolio outflows, given the historical outsized shareholding by foreigners on that blue chip stock. But overall, we see the Kenyan stock market is an effective barometer of the state of the general economy. Even if you look at the statistics from the Kenya National Bureau of Statistics, they're broadly in line with how the valuations in the equities market, the sentiment that it reflects, basically. Why do we like this? We like this because we can now identify with much more confidence which sectors we can invest in at different points of the business cycle. In terms of foreigners' participation at the NSE, we saw average foreigners' participation decline to 50% of overall market turnover, down, of course, from 54% a year prior. And we attribute this, of course, to the rising interest rates in developed markets that have accelerated portfolio outflows, as Stacey highlighted. And we know there's a high correlation between foreigners' participation and total market turnover at the NSE. However, we have to be careful because correlation doesn't necessarily mean causation. And even if we funnel down to the counters where foreigners were displayed the net bullish and bearish sentiment, beginning with bullish sentiment, we saw foreigners display positive or optimism for select counters in the banking sector, notably Equity Group, ABSA Bank, and also Stanbic Holdings Kenya. While on the flip side, they were largely bearish on Safaricom, British American Tobacco, and Cooperative Bank of Kenya, respectively. In terms of the winners and losers on the capital gains dimension, we saw Umeme Limited emerge the best in the capital gains dimension, recording a 115.6% return to close the year at 16 shillings, followed by Kapchora Tea, which recorded an 89.8% return to close at 215 shillings, and Kenya Orchards for last year, which was the best performing, this year was third, recording an 87.5% return. On the flip side, we saw Unga Group among the lead, infamously taking the top loser position, shedding 47.3%, close the year at 16.85, followed by Kai in General, shedding 47.3% as well to close at 25 shillings, and TransCentury shedding 44.1%. We also conspicuously saw some blue chips like KCB, Safaricom, and East African breweries feature also on the top losers list. And as I discussed earlier, this valuation loss largely reflects the impact of macroeconomic shocks on these counters, while these small caps, which are leading the charts on the top gainers field, broadly reflect the process of the pricing in of the fundamentals. They're still on a journey of price discovery. In terms of the top dividend yielding picks, 2023, again, we saw Umeme Limited emerge the best counter on the dividend yields front, posting a 15.6% return, followed by Kenyan, posting a 14.9% dividend yield, and Williamson Tea posting a 14.4% effective dividend yield. And ironically, we see a Ugandan cross-listed company, Umeme, emerging the best in the Kenyan equities market, both in terms of capital gains and dividend yields. And another aspect you can notice is that broadly you notice energy companies, these top 10 listers are a diversified mix of companies from the energy sector, agriculture sector, banking, and one from the manufacturing sector. Allow me to shift gears briefly to the fixed income outlook, where 2023 was very agile for bond markets, primarily shaped by soaring yields, where because of the rising interest rates, rising global uncertainty, and the macroeconomic pressures, this led investors to increase the premiums they demand in purchasing treasury bonds and treasury bills. Secondly, we also saw the Central Bank of Kenya essentially shift its strategy towards issuing short-dated treasury bonds, as opposed to the previous strategy of issuing a mix of both long-dated treasury bonds and short-dated treasury bonds. However, the rising yields, as we'll see in the coming slide, still presents new challenges in terms of refinancing debt on a sustainable basis. And now it even raises the imperative for government to source cheap debt even in external markets. The third thing we think shaped the 2023 fixed income market was we saw a general slowdown in secondary market activity, of course contributed firstly by the rising yields, which shifted attention towards the primary market auctions, and also because of the rising interest rate environment, some bondholders were largely discouraged from liquidating their bond holdings. So I'd like us to take a deeper look at the yield curve, where on the external front, we saw the rising interest rate environment leading investors to raise the premiums they demand in purchasing treasuries. As such, we saw the yield curve move from a normal curve, that is the black line at the bottom here, to effectively invert by the end of 2023. And we think this trend is likely to persist even for the better half of 2024, as indicated in our forecast curve. We think, firstly, on the external front, rising interest rates globally triggered or accelerated this trend. However, even domestically, the rising concerns around fiscal debt sustainability and also the elevated inflationary regime and the weakening shilling led investors to raise the premium they demand in purchasing treasuries. So we expect the yield curve to remain inverted for longer, even in the positive scenario of possible rate cuts in 2024 in developed markets. And as such, we think the bond market still remains a buyer's market, as the current uncertainty places bondholders on the edge. Nice. So this is where we wrap it up with portfolio management investment implications for you, the investor. So what do all those previous slides in terms of what implications do they hold for you in your investment decisions heading into 2024? Firstly, we think there are a number of major investment implications owing to the findings we've just discussed. Firstly, we think investors will need to be more selective in how they select their securities. And because of the new regime, a new season of higher volatility across and within asset classes, investors will be better rewarded from better selection of securities. And the second implication we identify is that we think investors will need to be more dynamic in how they allocate and rebalance their portfolios. As we discussed in our investment play 2024, we don't think the typical buy and hold strategy will hold in light of the volatility that's ahead of us in terms of the equity and even the fixed income markets. So there'll be need for more dynamism, more frequent rebalancing of portfolios, tilting them towards the outperforming sectors as the business cycle evolves. And thirdly, we think now investors will need to prepare for volatility. And how do we do this? I think investors will need to incorporate more alternative strategies, of course, including geographical and sectoral diversification, as well as incorporating derivative overlays like equity futures to mitigate or even hedge overall risk exposure. So in terms of our equities portfolio for 2024, which we highlighted in our 2024 investment play, we comprised a portfolio after an analysis of all counters and looking at their earnings trajectory, looking also at the fundamental valuations and even the trading multiples. We developed a portfolio which we outlined will be rebalancing on a quarterly basis, tilting them towards outperforming sectors and letting go of the outperforming sectors as the business cycle evolves. We are seeing signs of reversal in equity market sentiment, held in check by tight financial markets or the high interest rates, as it were. Yet, we see several bright spots at this point of the economic cycle. We are bullish on some select stocks in the agriculture, financial services, energy, and construction sectors. Firstly, we're bullish on a bit Maturity and Williamson-T, largely because their earnings trajectory by half year reflected tremendous or agile growth, growing in the triple digits. And we think even the tailwinds from the depreciation of the Kenya shilling still offers a lot of headroom for these counters. Banking sector valuations were bullish on Equity Group, I&M, and NCBA, broadly because of their unique value propositions, and also their trading multiples also remain below industry averages, signifying some headroom for price discovery. For CIC Group, we like the exposure to long-term insurance, and we think because in light of the shift to IFRS 17, we think it stands to benefit from the unwinding of contractual service margins. And even for Jubilee Holdings, its leadership on the medical insurance front, despite the pressures by half-year earnings, we still anticipate or we still see some significant headroom for price discovery at current levels. For Umeme and Kenyan, and one may ask, didn't Umeme just issue a profit warning recently? Yes, while we do concur with this profit warning, looking deeper, we note that the attribution to the profit warning is largely due to an increase in amortization owing to the moratorium expiring in 2025. But more importantly, the free cash flows of the business still remain in the safe territory, largely because amortization is a non-cash expense. So we are not concerned with the profit warning, as it were. Even for Kenyan, we like the ongoing expansion of the Olkaria 4 and Olkaria 1 plants to yield an extra 30 megawatts of power as they phase away thermal power and ramp up geothermal production. For Bamburi, you also see significant headroom for price discovery, just hot off the heels of a decent exit in Hima Cement in Uganda for $84 million. We think this unlocks a lot of capacity for expansion of existing plants, as well as the capacity to pay off higher dividends in this financial year. Broadly, we expect net outperformance in these sectors, and one may ask also why is there conspicuous absence of some select blue chips in our equities market like KCB and Safaricom. And to that, I answer that because this portfolio is meant to be very dynamic, we urge indulgence in looking at our subsequent publications, including our monthly stock recommendations, wherein we'll be giving frequent reviews of our all our stocks and our coverage, and also giving renewed valuation opinions as the business cycle evolves, because we said we are in a regime of higher volatility. So currently, especially for those counters, as we highlighted in our January 2024 stock recommendations, KCB and Safaricom, we're currently at a hold position or hold recommendation as we wait their full year earnings performance for 2023, and then we shall release a comprehensive update as and when the results are with us. In terms of now our fixed income portfolio recommendation, we recommend that conservative investors take up duration by building up a balanced portfolio of spot treasury bills balanced by medium to long duration bonds to lock in their active yields at the present. And for income-oriented investors, we've compiled a list of top coupon-paying bonds ranked by coupon rate, of course, gross of withholding tax where applicable. So with that, I was actually concluding my presentation. Thank you all for your patience. And now we'll open the floor for Q&A.
All right, thank you so much, Ronnie and Stacy, for that insightful presentation. We'll try to get through as many of the Q&A questions as possible. Okay, so I think this is addressed to Anthony. What are derivatives and how can I invest in them?
Without making it complex, basically a derivative is a financial contract that derives its value from the performance of an underlying asset. In our market, we only have futures contracts. Basically, these are contracts that track the underlying performance of several key stocks in our spot market, that's the equities market. And these stocks include KCB, Safaricom, EABL, etc. So we have futures contracts for 10 of these stocks, and highlighting the importance of derivatives. Derivatives offer dual opportunities for investors, basically to profit when the market goes up and also when the market goes down. So that's a major advantage for derivatives. And I know some of you have been asking, how can I take advantage of uh, our market, especially when the prices of shares is going down? So basically, that's the first advantage, where you can short sell in the derivatives market. Another factor that Ronnie mentioned was that investors will need to prepare for volatility, because we are entering a time where we're going to experience a lot of volatility in the markets. Then this highlights the importance of hedging, and which is another advantage of the derivatives market, where you can hedge your portfolio using futures contracts in our local derivatives market. You can visit our YouTube channel. We have several videos on the same. So basically, AIB-AXYS Africa, and just search investing in derivatives in Kenya. We have a whole series of 4 videos explaining everything you need to know. You need to know about derivatives in Kenya. Thank you so much.
Okay, great. Thank you, Anthony. It's great to learn that with the declining prices in the stock market, you can still make a profit through the derivatives and use them to hedge or protect our portfolios. So maybe, Anthony, you can put your email as well in the chat, and anyone who wants to pursue that can contact you. I can see Frank has asked, what is your take on KCB and Safaricom? Ronnie, maybe you can take that.
All right. I have seen a lot of questions streaming in on KCB and Safaricom. And as I discussed in the presentation, we urge indulgence to engage with all our subsequent reports. Every month we release monthly stock recommendations, wherein we give updated reviews or valuation updates on all these counters and our coverage. But let me just take time to answer that question directly. I think for KCB and Safaricom, the reason why we predominantly had hold recommendations on both counters for this January cycle, for starting with KCB, we saw a number of unique forces at play. Firstly, being the eroded or thinning capital buffers for the KCB Kenya banking unit, and even for the National Bank of Kenya subsidiary. And we think that also will sink in a lot of free cash flows in order to restore the capital adequacy back to significantly above the regulatory minimums. While also we acknowledge the recent acquisition of Trust Merchant Bank in DRC Congo came with significant deposits to the overall group base. And also the fact that we witnessed significant growth in operating incomes for the group overall. On the flip side, we're also seeing a rising non-performing loan ratio that's significantly weighing in on profitability, compelling management to increase the forward-looking reserves that they ought, or that IFRS 9 requires of them to do. As such, we had to reevaluate our break-even projections, and even the market valuations will broadly reflect those risks as we see it. So Safaricom, we think, looking at the numbers in Ethiopia, they just released an update on Safaricom Ethiopia. We see a number of bright spots in the Ethiopian market, fast growth in their recently launched M-Pesa business, even in triple digits. However, the expansion into Ethiopia came with significant capital expenditure budget, as you know, and scaling the infrastructure to the last mile was significantly at a huge budget. And we think this will take much longer than initially forecasted for the Safaricom Ethiopia unit to break even. So yeah, we had to reevaluate our prediction to a hold until we see a significant unwinding of profitability from the Ethiopia unit. However, this is just a very broad level analysis. We are working on a February stock recommendations report, wherein we shall go into further depth on all these counters in our coverage. Thank you so much.
All right, thank you. Thank you for that, Ronnie. And on the same note, in terms of the equities market, David is asking, what is the outlook for the telecom sector in 2024?
Broadly speaking, the outlook for the telecom sector broadly remains fundamentally positive, given the low elasticity of demand for telco products. We think the net outlook from where we sit is positive. However, we're seeing especially some revenue lines for Safaricom really mature and starting to display some dwindling revenue growth rates, especially for the voice business. There's emerging competition from over-the-top technologies likely to pummel profitability for the voice revenue line or voice segment. However, then the new growth frontier from how we see it lies in M-Pesa. We think the upscaling of M-Pesa to not only just a payment service, but also like a digital platform where they're onboarding third-party services, like you can pay for insurance on M-Pesa, you can pay for your taxi fees on M-Pesa, like all those third-party services being onboarded on M-Pesa is it unlocks a new growth frontier because there's some cross-selling, and as such, we expect revenues for Safaricom still to remain at top tier rates over the medium term.
Okay, great. Thank you, Ronnie. And moving to the global markets, Tony is asking, is there a possibility to invest in the USA market with AIB-AXYS?
Thank you, David. Yes, we do have access to offshore investments. And for that, I'd like to direct you to Mohammed Yassin. Maybe email us as research, and then we'll take it up from there with how you'll be able to invest in offshore as part of the greater AXYS group, where we have a number of offshore investment products, which I believe you'll be keen to elaborate more at a closer level.
All right, and back home, and we might not be able, just a notice, we might not be able to cover all the questions, but please feel free to email research@AIB-AXYSAfrica.com, and we'll be able to get back to you there. But for now, back home, Lee is asking, the NSE was one of the worst performing markets in 2023. Is this likely to change in 2024?
Thank you for that question. And this is one subject that we've indulged also in our 2024 Outlook, where that report on Kenya being labeled as the worst performing stock market in the world, we took issue with it because it only looks at one aspect, which is the Nairobi All-Share Index, and then summarizes that based on the performance of the NASI, which is a market capitalization weighted index, that the whole market now is worst performing. I think there are other attributes where the Kenyan market really stands out, not only in the region, but also the continent. If you look at the dividend yields, average dividend yields for the Nairobi Stock Exchange still remain top tier on an average level. And even the capital market infrastructure has made significant progress from how we view it. However, taking the comment as it is, when do we expect a reversal? And we said currently, because of the elevated interest rate environment, it is keeping the equity market sentiment largely suppressed, and the reversal from how we view it is pegged on up to the time when interest rates are likely to come down or signaled to come down by key central banks, not only in developed markets, but even here in Kenya. But broadly speaking, there is significant opportunity because majority of fundamentally sound counters are trading at discounted levels. And there's significant opportunity for price discovery. And we also, because of the infrastructure that the government is laying out, including incentives to lower corporation tax rates, all meant to, especially for foreign businesses, meant to attract foreign direct investments into the region. We think this is likely to come into play in 2024. Are even supported by other factors such as resilient growth in diaspora remittances, alongside other portfolio investments, chasing incentives such as the classification of special economic zones like the Two Rivers terrific zone as a special economic zone. So these incentives we think will support or will result in rebounded foreign direct investments, and as such it will also stimulate a reversal in equities market performance in 2024.
Hey, thank you, Ronnie. And I can see a lot of questions on individual stocks, ABSA, EABL, DTB, etc. If I would encourage those who have questions on individual stocks, we have a Telegram group, and every Thursday we open up the group to ask such questions on the markets and on the different stocks for guidance from our expert analysts, and they'll be able to answer your questions on the Telegram group. Ronnie, maybe you can put the Telegram link in the chat. So now to the fixed income space, there are quite a few questions there. There's a question on the current debt situation in the country. Is there any chance of, is there the risk of default once people have invested in treasury bonds and bills? Is there the risk of default by the government?
Thank you for that question on risk of government default. Of course, risks are conversation that we cannot totally write off. However, from where we sit, as we've discussed in subsequent publications, is that default risk is not a risk we really fear from where we sit, especially given the significant progress the government is making on the fiscal consolidation front. At least the expenditure growth is largely contained, unlike previous fiscal years. This also now repairs the eroded fiscal buffers. We're also seeing government progressively lower the public debt to GDP ratio, supported by net domestic refinancing, and also because while the revenue to GDP, but the ratio of debt service to revenue ratio has been on the increase, we still think that ratio is still within the sufficient or the manageable thresholds. And in terms of external debt sustainability, with regards to the Euro bond repayment of June 2024, we've outlined also in our investment outlook that we're not so much concerned about default risk as much as we are about the level of foreign exchange reserves after we repay and the subsequent impact on the Kenya shilling. However, because of the tailwinds that the government is really working aggressively towards to incentivize foreign direct investments into the region or into the country, we think this will offset such risks by the end of the year. Thank you.
Okay, I think because of time, I'll only take 2 more questions, but just a reminder that you can send your queries to research@AIB-AXYSAfrica.com or join our Telegram group, which will open every Thursday to answer questions on the markets. But still on the fixed income market, do you expect the treasury bills and bonds rate to continue to rise in 2024? By that, I assume the coupon rate. And he says, given it will take time for the expected lowering of the USA Fed rates to have an impact here.
Yeah, thank you for that question. In terms of our yield outlook, we've outlined that we anticipate that because of the rising global uncertainty, we think yields will remain inverted for longer or higher for longer, largely because the changing fiscal or debt sustainability indicators, like the rising debt service to tax revenue ratio, we think investors are pricing in such deterioration in fiscal indicators. And even in the positive scenario of interest rate cuts in developed markets, we still think interest rate yields in the Kenyan market, domestic market to be precise, will remain elevated, largely because of the debt sustainability risk profile that has shaped to where it is today.
All right, great. And for our last question, what are this is by Jeppy. Are there any influencing factors for a better forecast, I would say, in Kenya? I assume he's speaking about the stock market.
All right. I think as a parting shot, we remain net bullish or net positive for the Kenyan economy. Looking at even regionally speaking, there are very few places like Kenya with tremendous growth potential and inclusive growth like Kenya does. We saw in our Kenya presentation slide that services is now taking the shine. And we like this because services contribute the majority, almost 60% to GDP contribution. So we think this growth is more inclusive and is the basis for sustainable growth going forward. Yes, Kenya has its fair share of challenges. However, we think looking ahead, we expect, because of the easing or moderating price pressures, we expect real incomes to recover and stimulate recovery in consumption or consumer spending. And we think also consumer spending still remains the engine of economic growth for the Kenyan economy. In terms of investments, the government is still working on incentives to attract foreign direct investments. And we're seeing this in the numbers. Balance of payments account is projected to reverse into a surplus by December 2023. This is positive news. While we still have challenges in the current account deficit, we still need to invest in structural reforms to reinforce or to replenish our exports so that they are more competitive and that we are able to close the ranks on our public, or rather the current account deficit. In terms of the equities market, just in summary, we still remain net positive. However, as you pointed out, because of the regime of high volatility we are in, I think investors will need to be more selective, the more dynamic in how they allocate and select securities, and ultimately more agile, right? It will not do to do typical buy and hold strategies in this new regime of higher volatility as you see it. Thank you.
All right, thank you so much, Ronnie. And it's great to hear that we are still positive about the NSE. And as I said before, we are here to guide everyone who invests with us. We'll take the steps with you. We'll work with you in the journey. One of the ways we do that is through our Telegram group, where every Thursday it's open for Q&A, and we answer your questions in real time. So if you need any information on stocks, bonds, derivatives, offshore investments, you can reach out to us there or reach out to us through the research@AIB-AXYSAfrica.com email. It's on the screen. So if you have any questions from today or you want to step forward and invest in any of these opportunities, please do reach out through the email on the screen. Once you close this Zoom, you'll also get a feedback form. Please fill it so that we know how we can improve for the next webinar. Thank you once again to our speakers, and thank you to everyone who attended. We are grateful for the time that you spent, and I hope you all have a lovely evening.